Welcome to My Money Mindset podcast, where we explore how a healthy mindset is the foundation for financial success. Each week, we delve into mindset hacks and practical strategies to help you enhance your income, help you make more appropriate investments for yourself, and to improve your overall financial well-being. Join us on this journey to transform your financial future by transforming your mindset. Please note that the information provided on this podcast is for general information purposes only and does not constitute as personal, financial or health advice. It has been prepared without considering your individual objectives, financial situation or life needs. Before making any financial or health decisions, you should consult with a qualified professional or financial advisor to ensure the information aligns with your specific circumstances. So let's begin and enjoy this journey as each episode teaches us on how to improve our overall mindset that overall improves our financial success. Welcome to another mindset episode. Today, guys, I have had a lot of emails coming in from clients that are actually requesting, Mark, what do I do? We're looking at investing in shares or property. What do we do? What do you look at? What do we do here? We want to make as much money as possible. We know that the cash rate should be coming up, but going down. We know that prices of property do go up, but we've read a lot on the news as far about cryptocurrency shares, all that sort of stuff. I won't go into details in regards to the difference between crypto and shares. I'll do that on another episode, but realistically, deciding on to invest in shares or property, especially when interest rates are low, it's a complex decision, and a lot of it's got a lot of potential benefits to it, but there's also a lot of drawbacks on both options. So I'll break it down in this episode and give you the reasons, and you can decide for yourself, right? The pros between the pros and the cons of investing in shares or property. But realistically, shares is obviously, it's quite evident. Shares are quite liquid, right? So you could buy shares today, register yourself. There's so many different brokers on as far as buying shares in the market now. You find them anywhere on the internet. You jump on board, you create your own little platform there and you start investing, right? It's quite simple. It's a lot easier. You don't have all the stamp duty and everything covered over with what you do. Property, if you go to sell shares, you can literally sell them there and then, yeah, if they're good shares. I'm talking, open market shares, that sort of stuff. If it's shares within a local business, it's Harry's Fish and Chip shop down the road and he's selling 10% of his shop or something like that, it's a little bit different. I'm just talking trading shares that you see on platforms day in, day out, ASX, that sort of stuff. Whereas property, it's, you got to start looking for it, you got to look after it, you got rates, you got this, you got that, and it's that. What do we do now? Now, Australia has always had this influence on Australian property to go, look, it's a great Aussie dream. Is that still achievable with first home owners and all that sort of stuff? It's still very speculative when we look at that. But that being said, the episode is about comparing shares. What do I invest in, shares or property? So the pros with investing in shares with lower interest rates. So if we find that the cash rate's going to drop, it obviously will increase business profits. So low interest rates when businesses are operating and you're buying shares into these businesses, they can reduce borrowing costs for the companies and potentially lead to higher profits, right? So that means your share price is going to go up, right? So this is take into mind if this is the interest rates are going down. So remember, this episode is if the cash rate drops, and my clients were inquiring if the cash rate drops, should we invest in shares or property, right? Higher returns than cash. Obviously, historically, shares have offered the potential for higher returns compared to low yield cash investments, especially on low interest rate environment, which basically means that if it is, once again, and you find that there are some reputable shares to be purchased or what have you, then yeah, it will probably bring you a higher return than just placing your cash into a term deposit or something to that degree, right? And shares, obviously, there are some shares that offer dividend income. Many shares, like as in when you do buy them, they pay dividends, and they provide regular income stream for the investor. So you've got to double check which ones they are, which companies they do, but lower interest rates can make the dividend yields more attractive relative to fixed income investments, right? So it means that if the companies once again are making more profit, obviously their dividend yield is going to be higher, right? So that's in a simple term, but it is the truth. It's a reason why a lot of people do invest in shares is because of the yield. They put in $1, and every now and again that dividend yield comes back at 10 cents or 3 cents or something to that degree. Obviously different shares provide different yields on their dividend, right? So very, very popular reason why people invest in shares. They can also what they call inflation hedge. So shares can potentially protect investors against inflation as company earnings and asset values rise with increasing prices. So what that means is if the inflation rises, as in the market, companies, depending on what company it is, they can actually they flourish. Their company earnings and asset values increase, meaning that your share price or dividend could potentially increase, more so your share price, right? So it's a great way to sort of, if you're anticipating inflation in the market, it'll be a great idea to think about that. Inflation often occurs when interest rates drop. Okay, it's not a given, but it is a general sort of, let's measure the way everything's going. If interest rates are to drop, then obviously that's going to cultivate a lot more spending, right? With a lot more spending means that inflation begins to rise, or it's got a massive influence on inflation and where it's going. So if that's the case, company earnings and asset values will also rise, and that increases the share price, right? Good little point, that one. Liquidity. Now, shares are generally easier, like I was saying before, and quicker to buy. Meaning that they are easy to buy and sell at the time compared to property. I mean, obviously we all know how long it takes to put your property in the market, that sort of stuff. But with shares, it's literally bang, overnight, there and then. Many times when I trade shares and you're looking or you're thinking that you want to sell them or create a bit of liquid cash in, you sell them. So they are quite, as I call them, liquid. They're quite flexible and easy to trade than what it is with property. And they're obviously, like I said, the initial outlay is a lot smaller than property. So if you're a wannabe property investor and you're thinking, God, I wish I could get a property, but I've only got 10 grand or 30 grand, or I don't have enough grand to buy a property or make it worthwhile, you can always have a look and speak to obviously your brokers and stuff like, and your accountants, and find out, is it worth investing into shares? Now I remember doing this many years ago, where I'd invest in shares simply to make my savings increase in value. It doesn't mean I was going to keep some of these shares forever and then but it meant that whilst I put my dollar in the shares, it was better off putting my dollar in the shares than the bank's account as savings. Even if it was on a higher return, it still wasn't going to be as high as what I would have got from the shares. And actually, that's what actually happened. So I invested in a lot of shares, and with the money that you make on those shares, it increases your deposit and you keep saving on there. What they call a dollar cost averaging saving. What that means basically is, doesn't matter whether the market's going up or down or sitting where it is. Dollar cost averaging is when you buy, you can do it with crypto as well, right? You literally put away $100 automatically and just deposit it into buying shares. You want to have a look at broker costs and stuff like that, obviously, and make it worthwhile. But what I was also doing a lot of the time with shares was dollar cost averaging. So if you've got a spare $100, or let's say, for instance, you refinance your home loan and you're saving $100, and you think, I won't put it back into the investment property because it helps me with my my tax deductibility and stuff, and I want to put it into something else. So that $100 that you normally would have been given to the bank because of a higher interest rate, normally these ways, you can actually put it back into buying, as in dollar cost averaging, put it back in monthly into buying shares, and it sort of accumulates your share portfolio, and you can start getting dividends, right? So a bit of diversification. That diversification investment strategy is often very popular. Well, it's popular with me simply because you're diversifying your dollar. So if you're placing 20 cents in shares, 70 cents in property and 10 cents in somewhere else, or crypto, or whatever it might be, that's diversification. You could also be buying property as commercial, residential. I think I did an episode on that. Yeah, diversifying your risk. So if you find that shares are going up 1 minute and property down, or vice versa, at least you're diversifying your portfolio of savings in these potential investments. Now, it's not all good and thumbs up with shares. There are some cons. Obviously, the share market is very highly volatile, so the price of shares fluctuate. A lot of people lost a hell of a lot of money in shares. So you definitely want to be able to read the market. If you're someone that sort of says, well, I don't really like shares, but I know they give a good return and I should be investing in them, really speak to someone or do a lot of investigating, because sometimes, like I said, the volatility in the share market, wow, it can really knock people for a six, and it doesn't do you any good. And even though share prices, they drop, you've got to be able to have the personality to hold on to these things or sell them and cut your losses, so to speak. And there's no guaranteed returns. Now, that goes with any investment, but I always say with shares, there's no guaranteed returns as what there are for some fixed income investments, right? We all know that property at the moment isn't really going up, and there's no sort of return. I mean, some properties are. You can put sweat equity. You can influence a property to go up, right, through sweat equity, renovations, or whatever. But that being said, with shares, you don't really have an influence on that, and sometimes those no guarantees in their returns can affect a lot of people. So if going back to the example of me, which it did happen to me, I bought some shares and they just didn't move. If anything, some lost. Diversification in my portfolio meant that the shares that were going up, thank God, were going up more than the shares that were actually going down. So it was still a bit of a win-win. So that diversification is a very important point. You've got to also remember that the shares, they are a company, right? And if it's a company, so let's say, for instance, you buy a company A and company B shares, and company A is going gangbusters, but company B is not. The performance of that company B, that's probably getting influenced by the specific circumstances within the company, not so much just economic influences. So it could mean that A and B are very similar in a company, but B is not performing as good. Who knows why, but they're just not. And it's an internal problem that can affect it, right? So really be company specific. So if it means that you're going to invest in mining or tech, you want to make sure, okay, who's in technology? Start to break it down. There's different companies that are, more on hardware, software. What are the market demands that you believe are going to go up? So buying shares is like buying a business, so to speak. You are buying a portion of that business. So you really want to do your homework and find out what are the influences and why you believe that these share prices are going to go up. And obviously a lot of the YouTube channels and stuff like that, they have all that, feeds, everything. I'm not one to believe a lot what I hear on the internet. I like to do a lot more market research as in the actual figures that are supplied annually, or could be every half a year. You get the figures, the facts, you do a bit of investigating. You don't always hear about something on YouTube or on a social feed and believe it. Really do your research and find out financially what are the influences, everything about that company, right, before you go buying into their shares. Now, this is with low interest rates. They are beneficial, right? But let's say, for instance, the interest rate was to increase, it could place a real negative impact on that company. So it means that if interest rates start rising, what we've seen in the past, that company can also be affected by this, because it leads to decreased stock valuations within the company. And if the stock valuation drops, that stock price drops overall, right? It has a massive influence. So that's another thing. If interest rates going down, it doesn't really affect it so much. It does in a good way. It affects it most of the time. It's not a given, but it generally does. And then you've also got to make sure, but if the interest rates start going up, well, buyer beware. Investing in property with lower interest rates as opposed to shares. Well, realistically, low interest rates directly translate to lower mortgage repayments, right? We all know that a lower interest rate with lower repayments, where that goes in your pocket, give it to the kids, God bless, or invest that into something else, right? And what generally happens if the lower interest rate, like I was saying before, it generally increases inflation, and that will bring a share price to go up, but it may also bring a property price to go up because demand starts kicking in. It starts to become a seller's market, meaning that the seller of the property will start to reap higher auction rate bids and stuff like that, right? As auction bids, or people will be bidding a lot higher to buy that property when generally, as a rule, when the interest rates are lower, right? Obviously, the investment property gives you rental income, right? So that's another thing, obviously, with that shares. They have their dividend income, whereas property has the rent. It's a tangible asset. It's something that's physical. Yeah, you can see it, you can touch it. It's sort of, that is quite a big deal for some investors. I know for even myself, a little bit old school in that sense. I do like to know the property down the road and drive past it here and now and then. Doesn't mean that you can't buy property interstate or far away or anything like that if it makes perfect financial sense. But it definitely does help for people like myself that want to see it and see what's going on, or the tenants, how they're keeping the property, that sort of stuff. You can actually lever it as in the property price, right? So you can lever off the value of the property. If the property value is going up, it can amplify potential returns, right? But then if the property goes down, then it's a loss. But that being said, lower the cash rate lowering or interest rates lowering means that the portion of the property value is sort of going to go up. And if you refinance and want to get cash out, or refinance and use that equity to buy another property or buy more stuff, or renovate, do whatever you want. That's many a time what a lot of people do, right? Or consolidate debts, which I'm a real big fan for. Especially to people that have got car loans and stuff that really don't make sense. Guys, you know what I think about all those sort of little biddly bits as in personal loans and stuff. If you can consolidate those, because quite often personal loans, car loans, credit card interest rates, they're higher than property loans. So if we can afford to wipe them clean, God bless, and it makes financial sense, yeah, do it all the time. But then that being said, with property, it is higher entry and exit costs. So when you go to sell the property, you've got agent fees, you've got a hell of a lot of other fees, right? Conveyancing. With shares, it's probably just a brokering fee on interaction. So when a transaction of, let's say, you're buying, or a transaction of when you're selling, that sort of stuff. But with property, it's more the cost of, and the fact that houses aren't as liquid as shares. You just can't, click your fingers and say, well, I'm going to sell the shares, I'm going to sell the house. I mean, you can, but it takes a lot longer to sell than what it does shares, right? Obviously, the capital outlay is a problem here as well. It requires a hell of a lot upfront deposit. So going back to that analogy of saving money for a property, whilst you're saving, you can probably have a look at investing in shares and that sort of stuff. Ongoing cost of property is probably one of the biggest sort of expenses, as opposed to with shares, as opposed to, stamp duty and stuff like that. But the ongoing things like repairs and costs and stuff really put a lot of investors off. That's why they often choose shares. But if you're sort of one that say, well, look, that's, relatively, I'm a slow burn when it comes to, increasing my capital wealth through property, I'm happy to do that. And if property is always to double or every 7 to 10 years is what it's done in the past, I'm happy to do that and cop the brunt of the costs because they're tax deductible and it makes financial sense. Then a lot of people don't mind, but it is a lot more costly to hold on than what it is shares, right? And that also means that just like shares that are vulnerable to interest rate hikes, so too are properties. So obviously they feel the effect, and you've got to make sure that you've got that covered and you're happy to sit on property. If the interest rates are going up, you want to sit on them and not take a loss. Some people are, depending on your circumstances, it's quite a very individual circumstance that if you wanted to be able to discuss what you do you hold onto something that isn't giving you return? What do you do there? It's not a quick answer. You definitely want to have a look at tax returns and stuff, your performance, the property. You want to have a look at the future, what's going on with it. I'm happy to discuss that as well, of course, but you definitely want to make sure that you've got all that covered. Now, make sure that your financial position, assess it properly, right, before you go buying into shares or property, or make sure that you do all your research and you can comfortably afford what you are buying. It doesn't mean you hurry up and invest because that's what the trend is at the moment. Make sure you can. Make sure that you are risk tolerant. Make sure that it aligns with your investment goals. Make sure that the market conditions aren't going to sort of throw you off. Your job's okay. You're pretty secure. You can, if the job's not or your business is not, you want to make sure you can ride the wave when you drop income or have no income, that sort of stuff. Always have a look at that. In conclusion, there's no real, what's better. It really does come down to the individuals. I have sort of tried to net out the main considerations for this. Obviously, there's a lot more little micro details in between these little nuggets that I've just presented in the episode. You definitely want to make sure that when you are investing, once again, speak to a professional, do your research, speak to a lot of professionals for that matter, and do your research when it comes to that sort of thing. You are investing to make money, not to lose it or just let your money sit there. So, if it means a lot of the time, people of you that are considering buying shares in the local business, as in, or, you see startup businesses and stuff like that, I really find that a very difficult one because a lot of time that's needed to research into startups and stuff like that. But if it's your mate that's starting up and he's offering you 50% of the business, that sort of thing, that's a little bit different. You definitely want to have a look at that. Once again, you want to have a look at who's doing the business, who's operating it, who's looking after the financials, the whole kit and caboodle. You definitely want to overlook everything. So if you do want to discuss it, just ring me. We can easily find out what's going to be probably a better thing for you to have a look at. In the end, you've got to make a decision, and that, I suppose, what's all becoming about an investor is becoming about making these decisions and understanding. And it's only these decisions when you do the hardcore research that's going to help you with this, right? It's speaking to people, it's finding examples, what works, what hasn't worked. There's no set and forget general rule of this, but we can sort of understand the fundamentals of what the advantages are, and we can also read markets or potentially see what's going on in the market to influence our decision. So I hope it helps, guys. All the best with your investing, and see you on the next episode.